this is John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, May 9. Are we witnessing a healthy pullback, and is the worst behind us, or is the worst yet to come? Just how severe will the slump get? Several readers have asked me if now is a good time to go bargain hunting, especially in the battered technology sector. Problem is, stocks might not have bottomed yet, and trying to time the market, well, it's a fool's game. Let's look at the positives and negatives underlying the market. If you're unnerved, I don't blame you. Investors have been subjected to a wild ride of sharp ups and downs. The combination of Federal Reserve tightening, rising inflation, and the increasingly bloody Russia-Ukraine war has weighed on the stock market. Take a look at the following chart. The tech-heavy Nasdaq is in bear territory. The S&P 500 is in correction mode, with the Dow Jones Industrial Average not far behind. The S&P 500 logged its fifth straight week of losses, the index's longest losing streak since 2011. The benchmark 10-year Treasury yield surpassed 3.1%, the highest since 2018. The rising yield is clobbering the technology sector. It hasn't helped that mega-cap tech stocks have posted mixed earnings. Now take a look at this chart. Crude oil prices have resumed their ascendancy as Western sanctions against Russia and supply disruptions continue. Helping drive crude prices higher is expanding Chinese fuel demand despite strict COVID-induced lockdowns and the country's weak economic data for April. The major industrial city of Shanghai remains in lockdown, but the rate of infections is starting to wane, which is good news for China's economy and hence for oil demand. The energy sector led all 11 S&P 500 sectors last week with a 10% gain. The Federal Reserve last week announced a hike in interest rates of 0.5%, the biggest increase in 22 years. The Fed's Open Market Committee said in its May statement on Wednesday, the committee is highly attentive to inflation risks. Stoking those inflation risks has been a greatly improving jobs market. The Labor Department reported last Friday that total non-farm payroll employment increased by 428,000 in April versus 380,000 expected. Jobs growth in April was widespread, led by gains in leisure and hospitality, in manufacturing, and in transportation and warehousing. Over the past 12 months, average hourly earnings have increased by 5.5%. Is a full-blown crash waiting around the corner? Perhaps, but in my view, not likely. See the following chart. Corporate earnings growth continues to provide a floor under stocks. According to FactSet, as of May 6, 87% of S&P 500 companies have reported actual operating results for the first quarter of 2022. Among these companies, 79% have reported actual earnings per share above estimates, which is above the 5-year average of 77%. The blended earnings growth rate for the first quarter is 9.1%. Blended combines actual results for companies that have reported and estimated results for companies that have yet to report. As long as corporate earnings and jobs growth remain strong, the stock market should find sufficient traction to avoid a meltdown. The real test will come with April's Consumer Price Index report due for release Wednesday, May 11. If the CPI numbers come in hotter than expected, all bets are off. Worried about the risks I've just described, but still looking for reliable growth? Consider the booming marijuana industry. We've seen many pot stocks explode on the upside despite the broader market swoon as marijuana legalization gathers steam. There are plenty of reasonably priced cannabis investments available if you know where to find them. I've done the homework for you in my new book, The Wide World of Weed and Psychedelics. It's your definitive guide for making money in the thriving cannabis and psychedelics industries. Click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. Thanks for watching. Yes, the market has been choppy lately, but stay invested and stick to your long-range plan.